It's coming for our cognitive jobs. The steam engine came for our muscle jobs, but AI is coming for our cognitive jobs. It's that we don't have a plan for this. It's coming too fast.
We want to talk about what's really going on in the economy.
Chris, what actually do you think is happening right now?
We're at the tail end of a very, very, very long credit cycle, and it's going to take a while to sort of unbreak itself. But that's just what I think from a monetary standpoint. What we did was we were expanding our debt levels in the United States. Now, I'm not just talking federal debt. People talk about it, 39 trillion, big number, sounds scary, but we have 105 trillion of total debt in the US system right now. So that's corporate, household, government. And that's a huge number. And it's way above anything we've ever seen before in terms of debt to GDP. And the thing to a debt cycle like that is you always have to find the next thing that you're going to borrow that much money for. So in 2006, 2007, it was houses, and then the government picked up the slack for a while and borrowed as much as it could. Now we're borrowing for AI. You always have to have that next big thing. And so the question is, what's the next big thing? Can we do this for another cycle, or have we kind of hit the end of the road here? And that, I think, is the big dialogue about, where we are financially.
So Chris, you have a huge community of people, right? And a lot of people watch you and they subscribe to your stuff, Peak Prosperity. What's on their mind right now?
I'll tell you, the vibe right now is there are two big things that people are really sort of focused on at this present time. First, we're still trying to understand what are the actual shocks of the Iran war. We're missing a little over 1.2, 1.3 billion barrels of oil that didn't get produced, didn't get put into storage, didn't get put on ships, didn't go to market. And that represents a hole in the world's oil production. And it's a little unclear how that's going to get filled or what the impacts of that are going to be. And I think, generally speaking, all of us are kind of readying ourselves as if, that's going to be a pin in the economic system, right? Every bubble's always in search of a pin. And then the second big thing is what is going on with AI. Ken, Danille, this is such an enormously disruptive, possibly in a good way, but I'm using this word carefully, a disruptive new entrant into the field of play. And nobody really quite knows what to make of it because it's advancing so quickly. Like if you developed a point of view about AI 6 months ago, you have to develop a new one about it today because of how fast it's advancing. And so the big conversation is like, what do I tell my kids? What do I tell my grandkids? What do jobs even look like 2, 3, 4 years out? The story right now is that the United States, in order to minimize the impact on the world of the closure of the Strait of Hormuz and the shutting down of all of the petrochemical and also oil production, has opened up its piggy bank. And so we've been eating into our strategic petroleum reserve, and we've been running down our commercial inventories. We've been selling off our diesel and our gasoline to buyers around the world. And so that's helped keep the price down-ish a little bit, but there's only so far you can go in that cycle. And so now all eyes are on how fast can this strait reopen? And there's a race right now between our reserves running down in the United States and can we get oil coming back out again? And it's going to be a touch and go race. We'll see. But if we lose that race, huge implications, right? We're going to see gas prices far higher than we see them currently. And that would be very disruptive. So that's coming in August 11th to 14th, right? Perfect timing. I think we're going to have some really crisper answers just right about that moment in time, which way this is all going to go.
So real quickly, before we jump over the reserve issue, I think I know people don't quite understand how the reserves work. The way I've explained it is it's like having cash, you personally having cash, and depleting almost 3/4 of the cash, right? So let's say I had $1 million of cash and you went through this period of time where you needed it. Now you're at a really, really critical point and there's not enough cash left, right? Would you say that's where we are on the reserve side of the equation?
Yeah, I think that's great. So the oil business is hugely complicated, but let me make it simple. We pull it out of the ground, we store it for a little while, and then we set it on fire. That's the whole oil business, right?
Yep.
So it's stocks and flows, right? So this is a little bit like, let's use your example. It's a bank account, right? I'm a trust fund kid. I've been living off the interest, got $1 million in the bank. The interest is covering me. That's great, right? But all of a sudden I decide to dip a little heavier and I start eating into the principal balance there. right? And so there's only so far you can do that. But you know what's interesting, like Ken, if I said, you know, I'm going to take out an extra 100,000 a month from my $1 million account, I'm not going to notice anything till month 11
Yeah.
when all of a sudden it's gone. But otherwise, it feels pretty normal till then. And that's a pretty good analogy. That's right where we're at. We're really eating into that principal balance, which is our buffer, you know, in case something happens. Let's say, I don't know, what's the usual thing? You get a hurricane, takes out the Gulf flows for a little while, or some other natural disaster, or God forbid, there's some sort of a war we get into where, you know, our own supplies are sort of challenged in some way. So that's what your strategic reserve is supposed to be for. Biden ran it down. He turned it into a strategic political reserve, you know, and now we're eating into it further at this point. So we've never been here before. I mean, we've never been this low as a nation in terms of the amount of oil in storage compared to our demand. And so the way they measure that is called days supply. And we've never been this low in terms of days supply. I mean, we were running thin, you know. Hope nothing can go wrong from this point forward.
You know, that's used for, you know, some kind of a crisis to kind of stabilize the price at the pump, right? And so now we're so low that we don't have those excess reserves to stabilize those prices at the pump, right? Is that accurate?
That's accurate. Yeah.
Yeah.
And then, you know, it gets a little more complicated. The United States is absolutely just swimming in hydrocarbons. But we actually, most people don't know this. This is an interesting point. We are not energy independent with respect to oil. We're still a net oil importer. You know, we have a lot of other stuff. We're swimming in what they call natural gas liquids, which is propane, butane, ethane, tons of that stuff. We're a hard time getting rid of all of it. But oil itself, yeah, we're still importing oil. A lot of it from Canada, some of it now from Venezuela. But that's still something that I think most people seem to be unaware of because it's been confused. Our DOE has gone out of its way to confuse the issue for people, which I deplore. So I'm here to help try and unconfuse it.
I know we're starting to get surcharges on things that we order from somewhere, like let's say appliances from LA. They'll come here and there'll be a fuel surcharge. And so it's starting to make its way into the spending piece. And so the result of this is inflationary, right? Isn't that where this is kind of all headed?
Yeah, and there's it is indeed. And the most recent producer price index readings, which usually are about 3 to 6 months ahead of the CPI reading, those have been clocking in at 6% per annum. And then this most recent one we just got was horrifying. If you annualize that, it was a 43% rate of inflation. Now that's just a bad month, and hopefully this all backs off. But it's just showing that we do have this inflationary pressure now. It's starting to push into things. And then the conversation gets interesting because inflation has two components, right? One, it's a monetary phenomenon. Our government is deficit spending as if it's a huge emergency. The Federal Reserve is printing again. You know, their balance sheet is expanding, not contracting. And more than that, there's a whole new player on the field that we probably need to talk about, which is that if you take the government's interest payments in the most recent month of May, you annualize that, Ken and Danille, that's now $1.6 trillion run rate. And that operates like that's cash. That's cash goes out into the market. So it's almost like QE in the sense that what's QE? Well, that's fresh cash out in the marketplace that has to go do things. And so that's a big part of inflation, of course, is like lots of cash out there looking for things to do. And then the other side is going to be this cost push price increases, which I'm a little hesitant to call inflation.
So let me get this straight, Chris, because you kind of may have lost me for a second. So, you know, you're saying that printing money to pay for our debt is creating QE. Does that then create inflation?
Every time you print money, it always is inflationary. That's just
Even if it goes towards our debt, which is not. I mean, it's our debt, but it doesn't go back into our economy, I guess is what I'm saying.
You know, it never goes into our debt. We never pay our debt down. What we do is we pay interest on the debt. And then that interest, like if you had, $1 million in short-term T-bills, you would be paid effectively interest on those. And so, but we haven't paid our debt down in forever.
Yeah, we're 36, 39 trillion or somewhere in there, right?
39. Yeah.
Yeah.
Is there a way out of that? I mean, is there ever such a thing as going to be balancing our budget again?
The answer is of course we're going to have to someday, but not until we're forced to. I don't think it's going to be willingly because if you do that, so right now we're deficit spending about 6% of GDP, and that's a lot. So if you said we'll just take it back to 3% of GDP, you're putting the country into an automatic recession. There isn't a politician alive who's going to sign up for that.
Now we have potential of this oil and other things that are going to be inflationary. So what's your crystal ball say? Because we got inflation, interest rates. What's your crystal ball?
So crystal ball says, well, here's what we know. We know that Trump really wants lower rates. It's a political thing. It's a statement he's made. He wants them. And so there's going to be political pressure on Kevin Warsh to deliver that. Fine. But if you look at the long sweep, I'm talking like the last 40 years, and you ask the question, does the Fed lead or does the Fed follow? If you pull up the two-year bond, the rate of interest on that, you'll find that is leading the Fed both to the upside and the downside, right? So when the two-year rate turns up, wouldn't you know it, a couple meetings later, the Fed starts raising rates. And when it turns and goes back down again, a meeting or two later, the Fed makes the decision to go down again. So it's pretty clear they've been following the two-year rate because that's the market telling you what the price of money needs to be right now. Right now, the two-year rate is telling us the Fed needs to hike if they're going to follow that. Now, they could break with tradition. They don't have to do what they've done for the last 40, 50 years, but I'd be very surprised if there isn't a huge amount of pressure because the Fed doesn't really, it looks like they're setting stuff, but it's really the markets.
Right.
Let's be clear. The bond market is the big bully on the block, right?
It sure looks to me like we could be sitting in an interesting scenario, which what we saw in 2022, which is we've got these inflationary pressures, as which we know the Fed is going to be reactionary and they're going to increase rates to try to tamper down inflation. Is that what you see?
Yeah, and there's some other dynamic that's happening here. So we just saw for the first time, I think in, 40 years, I don't know how long it's been, Japan raised rates, right? So it kind of more, it's a little bit of it's more symbolic than anything, but they raised rates to 1%, right? And also we saw the European Central Bank also raise rates. And the other thing we've been seeing is these long bonds from all over the world, right? Japan, UK, the United States, they're all kind of going the wrong way. The long bonds are actually going up. So right before this war started, I think we were at 4.2 on the 10, and now we're at just what we're at 4.56 or something.
Yeah.
Wrong direction, not exactly where they wanted them to. This is not the right direction. The right direction would be for these to be coming down. My point is, though, that if Kevin is going to think he can maybe control rates just here in the United States, there's this larger phenomenon happening across the Western world where all the rates are kind of going up. And in part because, nobody wants to hold a 30-year bond at 5% if you think inflation is going to be 6 or 7%, right? So that's going to create a lot of selling pressure down there. And also, the Fed is going to have a very hard time keeping its Fed fund rate below the rate of inflation. Now, that just came in at 4.2% on the last CPI. But again, what I said is the PPI leads the CPI 3 to 6 months. So somewhere in the future, we're going to be seeing probably a 6% CPI print, and that's going to create a lot of pressure on the Fed to raise, not lower rates.
So what if the federal funds rate is lower than inflation? What does that really mean?
It just means that everybody holding their money on the short end is losing money at that. And it's a huge number now because it used to be they would take their whole maturity curve and sort of push stuff long, short, make a mix. Under Janet Yellen, almost everything got clocked on the short end, right? So now we're in a situation where somewhere between $9 and $10 trillion a year is rolling in those markets all the time. And so again, if the Fed tries to hold the rate lower than the rate of inflation, they're up against a $10 trillion market that's saying, well, we'd rather get more than that possibly. So it's going to be huge pressure, right? They'll have to step in and buy a lot of that debt if they want to keep the rates down.
Okay. What do you see when you see Japan knowing that they've been printing for 20 years, just like we're doing now?
I think of a cornice that hasn't collapsed into a avalanche of some kind. The pressure's just been building and building, and they've been very successfully kicking the can down the road. What I'm suggesting is we have to be alert to the idea now that we might be out of road in this story. Japan may not have, another 10, 20, 30% of GDP it can slap on top of its pile of debt at this point. And so eventually every central bank gets caught in this one dilemma, which is you can't control both the price of money and the quantity of the money. And so, like, are you going to print a lot of it? Well, then people are going to make the price of it, get expensive because they're not going to want to hold it. Or alternatively, we're going to control the price of money. We're going to drive interest rates, this way or that way. Well, now you can't control the quantity anymore. So you have to kind of pick one, and they've been able to sort of pretend like they've been able to control both. We've seen signs lately. It looks like they're losing, that football's getting a little slippery on them. And that's a big deal because, again, this has been going on for the whole world since 1971. We've just been totally divorced from any idea that we have any limit to how much we want to borrow and spend, except for how much we feel we can get away with at the time. So that's been going on a long time.
Yep.
So how does this really end, though? Like, you know what I mean? Like, how not end necessarily? What's the next step? Like you're saying, you can't control the price and the quantity at the same time. And you're seeing that, right? Because we were just talking about rates, if you lower rates, then people aren't going to want to invest in the bond market. And if you higher rates, it could have a negative effect on the economy. So what are the options here?
Danille, I struggle with that all the time. Like I ask myself if I had that hot bird seat, what would I do? And honestly, I would get a time machine and rewind and stop this malarkey back in the mid 90s. But, we sort of got caught in this perpetual treadmill of bailouts. So if you look at it this way, so 1987, oh no, the Dow crashes 25%. A young buck named Alan Greenspan, just cutting his teeth on his new career, puts what's called the Greenspan put, the Fed rides in, saves the day. Everything's fine for a little while. Then we had this double dip recession. So little bailout there. Oh no, 1994, there was this corporate bond market thing nobody remembers, but at the time it was terrifying. And then they really loosened monetary policy in 94, 95. That gave us the dot-com, price the eyeballs movement, right? That blows up. And then we get into Bernanke and he gives us his 1% blowout rates. And that gives us a housing bubble. And if you track what happened at each one of those times, the Fed basically doubled or tripled its balance sheet at each one of those moments, right? Crisis. So we came into 2019, right? September, we have this big repo madness, right? If you must remember this, right? It was scary, right? 10% overnight rates.
For sure, yeah.
And the Fed was busy re-expanding its balance sheet. And then, oh no, COVID, and that gave them the right to print, another 4 or 5 trillion on top. And they've been walking that back a little from 9. I think we're back down to like 6.5. Best guess, we're just gonna see some sort of an adventure where something can't quite be resolved, to the spirit of your question, Danille, and then they're gonna double their balance sheet again or triple it.
So they're just gonna print.
That's been I don't know what else they can do at this point.
But to your point, if they print, then people are not going to want to invest in the bond market as much because of the rate of inflation, correct?
Correct.
And then what happens over there?
Well, they've proven to be pretty resilient and tricky in what they've done, but just to show you how crazy this has gotten. So in October 2025, the Fed comes out with a research paper, the U.S. Federal Reserve. They're like, hey, we hear that there's like these treasuries offshore, and the Treasury International Capital Report from the U.S. Treasury called the TIC report. So you watch what's happening, and you have now the Genius Act, right? And they're saying, oh, I know what we'll do. We'll make these stable coins, and we'll make it by law. They have to be backed by treasuries. That'll create, the next wall of demand for treasuries. So they're just trying to find any way they can to vacuum these things up, but they have to, because China is selling their treasuries month after month after month. Japan is now selling their treasuries. The Gulf Coast states, because they have to reconstruct and also they don't have oil flows, they are selling their treasuries. So the demand for these things, Danille, to your point, it's not external anymore. That's there's not that much interest, as much interest in our paper as there used to be, right? So where's all that new demand going to come from? And they're probably going to have to manufacture it domestically. And I don't know if they can keep up with it because it's such a wall. It is $10 trillion a year in refinancings. It's crazy.
So when you say create it domestically, do you mean like the Fed is going to have to buy up the balance sheet, or are you talking about something else?
Well, it would be that, and or they're going to have to find some other avenues like the stable coins potentially is another avenue, or I don't know how they would do that, but otherwise the normal market way you would do this is you raise interest rates to the point where somebody like you or me says, "Oh, that's a good deal. I'd take that." If you gave me like short-term paper at 8%, I'd be like, "Okay, I'm in."
But
Right?
you're saying, but they're not going to want to do that because they want to lower rates,
Well,
most likely.
the struggle always is, so we were talking monetary policy, but from a fiscal standpoint, the government always wants to issue paper at less than the rate of inflation. They don't want to be paying 6% if inflation's 5. They'd rather be paying 4% if inflation is 5, right?
Hmm.
Because that allows that makes it cheaper for them over the long haul. So there's always a lot of pressure on the fiscal side to get our debt out the door at less than the rate of inflation. But
I see.
if that rate of inflation clicks up far enough, they can't get too far behind that, or they can't sell it. And so that's the concern. Like if our PPI, CPI freight train sort of catches up, that means somewhere around September, we're going to be looking at 6% rates of inflation, which means the short paper is going to at least need to be 5. These are the two big pieces that have to come together. So in the 70s, part of the reason that inflation really helped eat the debt away is because we had both a wage and a price spiral. AI is promising to take the wage out at the knees in this part of the story.
What's your crystal ball with regard to AI, wages, labor, unemployment, which is one of the things the Fed has on their radar, right? So where do you see?
But also how it ties into everything we've just been talking about too with inflate, because just because you have inflation doesn't mean you have wage inflation.
You can in inflation without wages is called stagflation, and it's the worst of all possible worlds. It's kind of a benign term. Sounds almost like a party, maybe fun, but it's not. Stagflation is the worst, and we've already seen that in the most recent data that wages are not keeping up with inflation right now, and so that creates the hardship index. If you see like the consumer confidence index is plumbing lows, that's another way of saying, yeah, people have figured out that their wages aren't keeping up with inflation. And that makes them miserable, right? All right. So crystal ball. So we already know that we've seen lots of layoffs because of AI. Maybe not the huge floods some thought, but plenty. Like 700 lawyers at Meta or whatever the story is. Or I think that was Microsoft. But I've seen it in my own small firm, right? Like so we are doing a lot more than we ever could because of AI, and we're leaning on it as hard as we know how. And so we are getting a lot more done, where I think just 3-4 years ago, if I wanted to get that more done, there would be extra people working with me on this, right? So that's sort of a negative space. It's like the people who aren't hired because AI allows you to do more with less. But the truth is that it's coming for our cognitive jobs, right? The steam engine came for our muscle jobs, but AI is coming for our cognitive jobs. It's that we don't have a plan for this. It's coming too fast, right? 4 years ago, nobody's thinking about this. I wrote my first report about what I saw coming because I couldn't figure out all this data center construction. And it was, a couple years ago. And I was like, well, what even is this? It was like completely obvious in the data center data, even though I didn't understand just how incredible AI was going to be. I think we were at like Chat GPT beta, when I was starting to go, something's happening here. And now here we are, and it's just a few years later, and I talk with people in the space all the time, and every 3 to 6 months, we're getting like these outrageous new upgrades to the AI capabilities that are almost too much to figure out. We saw with the Anthropic Claude Mythos release that they had to pull back and then give it to the banks as an emergency so they could begin to use it to find the holes in their systems. This level of development, this pace is beyond anybody's ability to manage or regulate, certainly beyond the cast of clowns we have that we call our politicians right now. But this is going to be a big deal. This is very existential. We're going to have to start asking questions like, well, if people aren't working, it's a political question, maybe a spiritual question too. If people aren't working, what are they doing? Are we giving them universal basic income? If they don't derive meaning and purpose from who they are in their professional life, what are they doing instead, right? So these are all huge questions that I don't see being asked and answered reasonably at the national level, which means it's going to be up to us to do it at the local level. And so that's the kind of conversations I'm really excited, to have at Limitless, because We got to talk about it. This is a big deal.
So how does UBI play into everything we have going on? Because I do think there has to, put it this way. My opinion is if the government expands, they give people unneeded jobs, which is basically UBI.
So if you track that story I told earlier of bailout, print, 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 print. We saw that like back in the 90s, households could make it at 30, 35,000. Then mid 90s, it was a 50,000 was your struggle session. And then on and on. I'm talking to people today who live in cities who are basically struggling at nearly the 200 level, depending on the cities, right? So the cut line for where your nose is just barely above water just keeps marching higher and higher every time they print. And so that's really the Fed saying, we're going to sacrifice another rung on the socioeconomic ladder. Like, sorry, just have to throw them under the wheels of the bus and off we go. And you can only do that so long before you create conditions where you create actual social unrest. That's something that actually plays in here at some point. So I really wish we could actually just have a national dialogue to say, look, if we could just cut all this back. And I don't know why DC, it's a one-way trip, right? It's like we went from COVID, we went from 1 trillion to 2 trillion deficit spending. And then it's like impossible to like get it back down. Like can't be done. Goes up easy, real hard to get it to go backwards. But if we're going to need it to go backwards for a while, and there you're going to have to make some tough decisions, right? What are we doing? Are we supporting retirees? Are we putting money into infrastructure? Are we doing all this military adventurism around the world, right? You saw Trump's, floated a proposal. Why don't we spend $1.5 trillion on that, right? And I think it's, national dialogue time. Like, well, okay, well, what do we get back from that? Because what if we put $1.5 trillion into this other stuff? And so you were just in Japan. You probably noticed, Kenny, right? When people invest in their cities and infrastructure, has a whole different vibe to it.
Right.
Feels good.
It does feel good. So we have this potential high inflation that you did in the first part of this podcast. And then you got this potential unemployment, which is we're kind of wrapping up with. And then you have the Fed right smack in the middle that has both things to deal with. What lane do they pick?
Crystal ball, they're going to do what they always do, buddy. They're going to print,
right?
They're going to print. Yep, we'll call it something. It won't be QE. What do they call their printing now? Is reserve management, balance management. They'll call it something else.
I love the marketing terms, by the way.
They were calling it QE light.
Look, I just love the Genius Act. Like it's all like they're all like just marketing terms. They throw everything. It's like everything's in the sink, and they just call it something and push it out to the public.
It's entirely possible that energy prices are going to get away from us later this year.
Oh, good point.
Every CEO of every major oil company has said this. Every senior oil analyst, everybody who's like in the biz, who's been studying this like I do, understands that, we're at these critical threshold levels. And maybe there's some way we just sort of like, ignore them, but we never have before in all of history. So maybe something's changed, but probably not. So it's always possible that this higher oil price just comes along and just lampoons anything the Fed thought they were going to do anyway, right? Just takes it out of their hands and says, wow, we have this massive cost push, inflationary pressure coming in. We're going to have to respond to that. And it's going to force them to raise rates.
And I'll throw another one at you. As you know, because you study this, owner's equivalent of rent, which is a big piece of the CPI right now, is nowhere on the radar because we're dealing with this, call it oversupply from low interest rates. But that's going to start taking off in about a year to a year and a half. And in 2028, 2029, that is going to be another significant piece.
And let me guess, based on my personal experience, property taxes and insurance.
Oh my gosh, they're coming after all of us, right? Because that funds so much, and so we're getting whacked. So our occupancies are down, our expenses are up, our debt costs are up, rents are flat. So my space is completely disrupted. It's a great time to acquire hard assets, which is what we're doing. But to your point, we've never seen. We're making decisions now, Chris, literally based on insurance rates. So we actually wrote off Florida completely and the Gulf areas of Texas because, if I can buy in Dallas and not have to pay double in Houston, For the same rent, that's a choice I'm going to make. Same thing in Florida, right? So you start to look at these little things, these property taxes, and they're not so little. Insurance, obviously another one. Insurance, property tax, but also utilities, and that these are major core things from an operator standpoint that we're looking at. We never really had to have so much focus on. And then the other one is the political risk. The mayors, the governors, the policies. That's another big issue, and people are moving because of all these, of course.
There's that, and then at Limitless, I'll throw in a heap of data because we have to talk about natural gas, electricity, grids, all of that, just the energy side of the story, which I remember last year at Limitless, people were like, oh, that's maybe interesting. I bet there'll be more interest this year because of what's happened to electricity. That was one of my big predictions. I'm like, hey, keep your eye on electricity rates,
And power plants too, right?
And power plants. We have to talk about that because
Ken
and Danille, I'm a little worried that it doesn't look like anybody's adding this up at the national level. Like this should be the Department of Energy, and they should be able to answer this one question. Okay, this is what I'll talk about a little bit, but just brief taste. We're about to take our LNG, liquefied natural gas exports. We're going to take it from about 17 billion cubic feet per day, double that, right? Another 18 billion cubic feet per day by 2030. That's huge. Where is that going to come from? And everybody sort of shrugs and says, oh, we've got lots. And I'm this guy. I'm like, point to the field. Is it coming from the Fayette? Is it coming from the Permian? Where is it coming from? Because every molecule is already accounted for. And so obviously, if you put a lot of demand on there and you don't have the right amount of supply, we call the response to that prices. So that's a fairly easy prediction to make at this point.
Yeah. Chris, where do people reach you that are listening?
Peakprosperity.com is my main website. Chris Martenson, the name Martenson. That's at Chris Martenson on Twitter. I'm all over YouTube. Very easy to find. But Peak Prosperity is where I have my main community of people. And, I run a subscription service there. And it's really, honestly, it's just for people who, A, want to hear what the truth might be, or I don't always know what the truth is, but man, I know it's BS, right? So you chisel away enough BS and you end up with something that's kind of like truth.